Hey everyone, Henry Wheelwright, Stablepoint Partners, Friday, October 10th, checking in with our clients and guests. Let's get right at it. It's been a phenomenal stock market. S&P 500, Nasdaq, Dow, all at all-time highs. Amazingly, the tech-heavy Nasdaq over the last 6 months up over 50%. Every single week, we hear more about AI, the disruption and the innovation, the amazing amount of CapEx, and we're all asking the same questions, asking teams like ours, what should we do? Are we at a peak? When's the correction coming? So let's address that and talk specifically about the future of this AI trade in our opinion. Number one, we think the market can go higher, and AI is still in the early innings, but you're going to see some statistics shortly that say, hey, today's winners, some of these largest mega cap companies, 3-5 years from now may not be the winners in this space. All right. First slide that I'm going to bring up that really is interesting looks at the CapEx spending of some of these mega cap US names, whether that's Oracle, Meta, Amazon. You see that rising trend. We're going to potentially have $3 to $4 trillion globally spent on AI out the next 3 to 4 years. It's a cohesive effort. It is truly unique, amazing, and eye-popping when we see the earnings. That being said, if you take a look at what we forecast on the right in that chart, it would not be unusual that we see front-loaded CapEx spending, a lot of money being put to work on large learning models, this idea of increased margins and productivity with AI, and we should start to see that rotate down. And we expect that to be a pivotal change in leadership. The next slide that I bring up really speaks to how hard it is to stay on top. If you look on the left-hand side of this chart, the top 10 companies in the S&P 500 by performance and return, over time, it becomes incredibly hard for those same 10 names to stay in the leadership. After 2-3 years, statistically, you see 70% of those companies go from top performers to out of that elite group. We expect that may be the case with some of the large leaders that we've seen around AI, the NVIDIAs as a poster child as an example. As we get further and further out with this AI trade, we may start to see some real change in leadership, and the market breadth should broaden. So we think markets go higher. Fed's going to continue to cut rates out the couple quarters. And much like previous periods of innovation, disruption, valuations really come into question. Is this the echo repeat of the dot-com bubble? What I would argue is, number one, valuations do matter. I think we should all be taking a bit of a pause on whether we want to take some profits. But generally speaking, if you look at this chart, comparing 2000, really on the back of those amazing runs in 98, 99 in the Nasdaq, to where we are in 2025, I would argue the quality of the leadership around AI is much stronger than the development and boom around the internet, now referred to as the dot-com bubble. We saw earnings breadth be substantially higher, and we're seeing revenue growth at 2x to 3x in the leaders. So there are real revenue numbers. Earnings growth has been phenomenal in this space. And I think as I exit this video, history rhymes often doesn't repeat, but I have 3 lessons for our clients. Number one, look at allocations. You don't go broke taking profits. Number 2, history tells us that the leadership we're seeing from the top companies may rotate, so another reason to take profits, be careful. The third is, this is a much healthier rally in tech, so don't be surprised if it continues. Hope you have a great weekend. Stablepoint Partners, please follow us.